If you're building a 401k, you don't need a hot stock tip. You need protection because the biggest danger isn't a down year, it's a permanent loss that sets your retirement back 10 years. And here's the part nobody tells ordinary investors. Big losses almost never come from one mysterious black swan you couldn't see coming. They come from predictable traps you walked into while you were trying to be smart, fast, early, or just not left behind. In the next few minutes, I'm going to give you 4 simple Benjamin Graham-style rules that protect ordinary middle-class investors from big losses, the kind that can permanently damage retirement. These rules are not glamorous. They don't make for flashy TikToks, but they work when the market is loud, when headlines are scary, when your group chat is chasing the next AI stock, and when you're quietly wondering, what if I make one bad decision and I never recover? And stay with me, because rule number 4 is the one almost nobody follows. Even though it's the difference between a crash that feels like the end of your plan and a crash that becomes part of your plan. Let's start with a hard truth. Most people think risk is volatility. That risk is the market being down 20% in a year. Graham would tell you that's not the real risk. Volatility is a headline. It's an emotion. It's Mr. Market showing up at your door every day with a new mood. Real risk, the kind that changes your life, is permanent loss. Permanent loss isn't my 401k is down this quarter. Permanent loss is I bought something fragile at a foolish price. It broke, and my capital didn't come back. Permanent loss is what happens when you don't just experience a drawdown, you experience damage. And the terrifying thing is that permanent loss doesn't announce itself. It disguises itself as confident, as a story, as a sure thing, as something that feels safe because everyone else is doing it. So what do we do about it? We stop treating investing like a prediction contest, and we start treating it like engineering. You don't build a bridge by hoping the weather is nice. You build it to survive storms. That's what Graham's defensive investor mindset really is. Crash-proofing by design, not by guessing. Here are the 4 rules. Rule number 1 is the line that separates investors from gamblers. Rule number 1, draw a bright line between investment and speculation. Graham was blunt about this. He didn't say speculation is illegal. He didn't even say you must never speculate. He said you must never confuse speculation with investment. That confusion is where ordinary people get hurt, because speculation feels like investing when prices are rising. It feels responsible. It feels modern. It feels like you're doing your research. It feels like you're participating. But an investment, in Graham's sense, is something that, after careful analysis, promises safety of principal and an adequate return. Safety of principal, not excitement of potential. Adequate return, not a life-changing lottery ticket. So here's a simple test. You can do this in 10 seconds. If you own something and you cannot clearly explain why it should be worth what you paid for it, without using phrases like everyone's buying, it's the future, or it's going to the moon, you're probably speculating. And there's another test that hits closer to home for the 401k investor. If this position dropped 50% tomorrow, would you still be calm enough to keep contributing for the next 10 years? Not, would you be happy, calm? Would you keep going? Would you keep your process? Would you keep your plan? If the honest answer is no, you don't own an investment. You own a stress grenade. This is where a lot of middle-class retirement investing quietly breaks. Not because someone was reckless, but because they were normal. They had a job, bills, kids, a mortgage. The market felt like the one place where you could finally catch up. So they reached for a story, and story stocks are the most dangerous kind of speculation because they don't look like gambling. They look like belonging. Today, it might be AI stocks. Last cycle, it was crypto. Before that, it was .com. Before that, it was Nifty 50. The technology changes. The human brain doesn't. The trap is always the same. You're not buying value, you're buying hope. Here's the defensive investor approach that protects your retirement without killing your motivation. You create two compartments, and you do it on purpose. Compartment one is your core, your retirement, the thing that must survive. This is where broad diversification lives. Low-cost index funds, total market funds, S&P 500 exposure, and depending on your risk tolerance and time horizon, a bond allocation. This is your serious money. This is where you don't need to be clever. You need to be consistent. Compartment two, if you absolutely feel the need, is a tiny sandbox for speculation. A controlled amount you could lose without changing your life. And I mean that literally, without changing your retirement date, your sleep, or your family's safety. Most people flip that around. They make the speculation the core, and the core the afterthought. That's how you wake up one day and realize your 401k became a casino with tax benefits. So rule one is not never touch exciting stocks. Rule one is label it honestly. If it's speculation, treat it like speculation. Size it like expect it to hurt like speculate. And if it's an investment, demand investment grade standards. Safety first. Now, rule two is where we get more specific because big losses often come from something investors barely look at. Rule number two, refuse fragile balance sheet. If rule one is about honesty, rule two is about strength. In plain English, don't buy weakness. The stock market is full of companies that look successful on the surface, but are financially brittle underneath. When conditions tighten, higher interest rates, lower consumer demand, recession, credit stress, the brittle ones crack. And when they crack, you don't get volatility. You get permanent loss. This is the part Graham understood at a deep level. He wasn't seduced by glamour. He studied the foundation. A business can have an amazing story and a bad balance sheet. And a bad balance sheet can turn a temporary problem into a permanent disaster. So what does fragile mean? It means a company that needs everything to go right just to survive. It means heavy debt with thin cash flow. It means weak liquidity, not enough current assets to handle current obligations. It means low interest coverage, so a bump in rates or a drop in earnings suddenly makes the debt unpayable. It means a company that looks fine during good times and then becomes unrecognizable during stress. Let me translate this into the real world of a 401k investor. You might be thinking, I'm mostly in funds. I'm not analyzing individual balance sheets. Good. That already lowers the risk of any single bankruptcy ruining you. But there are still two ways balance sheet fragility sneaks into ordinary portfolios. One, concentrated bets, sector funds, thematic ETFs, the future of funds, aggressive growth funds, where the underlying holdings often share the same fragility: high leverage, cash burn, dependence on cheap money. Two, company stock. This one is so common, it deserves a pause. If you're holding a lot of your employer's stock inside your retirement plan, you're doing something very dangerous. You're tying your paycheck and your portfolio to the same engine. If the company hits trouble, you can lose your job and your retirement value at the same time. That's not diversification. That's doubling down on one story. Graham would call that the opposite of a defensive posture. So what's the practical Graham checklist version for ordinary investors? Here's a simple screen you can keep in your head. If a company can't comfortably pay its bills, it does not deserve your capital at a price that assumes perfection. If the business needs the stock price to stay high to survive through refinancing, new equity, hype-driven capital raises, you're not investing, you're funding a narrative. And if you're not analyzing individual companies, the defensive move is structural. Avoid making your retirement depend on fragile categories of assets. Don't let a theme become your plan. Don't let one company become your identity. Strength matters because it buys time. And time is what turns market crashes from disasters into opportunity. Which brings us to Rule 3. The one that sounds obvious, but is the most violated rule in the modern market. Rule number 3, no. Margin of safety, no deal. This is the heart of Graham. Margin of safety is the distance between the price you pay and the value you reasonably believe you're getting. It's the difference between stepping onto a bridge that can hold 10,000 pounds when you're driving a 3,000-pound car and stepping onto a bridge rated for 3,100 pounds because you want to go fast. Most people don't blow up because they bought the wrong company. They blow up. They bought the right company at the wrong price. Because price can be stupid. Price can be a stampede. Price can be a mood swing. That's Mr. Market, your emotional business partner, who sometimes offers you ridiculous bargains and sometimes demands you pay absurd premiums. Here's a common retirement killer mindset. I don't care what I pay. I'm in it for the long term. That sounds disciplined, but it can be a hidden form of laziness, and laziness at the wrong moment leads to permanent loss. Long-term investing does not mean price is irrelevant. Long-term investing means you survive long enough for time to work, and margin of safety is what keeps you alive. Now, if you're a defensive investor, you don't need to calculate intrinsic value with a spreadsheet that looks like a NASA launch plan. You don't need a perfect number. You need to avoid the obvious mistake, paying for perfection. Here's a simple way to think about intrinsic value without turning this into a valuation lecture. A company's value is linked to what it can produce for owners over time. Earnings, cash flow, and the durability of the business. If the price implies everything will go right for 10 years straight, that's not a margin of safety. That's a tightrope. And tightropes are not retirement strategy. This is where hot markets are dangerous for ordinary investors. In hype cycle, valuation stops being a measurement and becomes a punchline. People stop asking, what is this worth? And start asking, how high can it go? That's a subtle mental shift. And it's the shift from investment to speculation. So how does an ordinary 401k investor apply margin of safety? Two ways. First, if you're picking individual stocks, your standard must be stricter than the average person's because your downside matters more than your upside. You're not trying to impress anyone. You're trying to retire. So you demand a real operating history, real earnings over a full business cycle, financial strength, and a price that doesn't assume a miracle. Second, if you're mostly indexing, which is perfectly compatible with a defensive mindset, you apply margin of safety through behavior and structure. You don't chase performance. You don't keep rotating into whatever outperformed this year. You don't turn your 401k into a rotating door of fads. You don't see AI boom and decide your retirement depends on being early. Instead, you build a broad base and you keep buying through cycles because the margin of safety isn't this stock is cheap. It's my process is resilient. Let me say that again, because it's easy to miss. For the defensive investor, margin of safety is not just a number, it's a system that prevents you from paying top dollar for excitement and prevents you from selling bottom dollar out of fear. Which brings us to Rule 4, the rule that turns all of this from theory into a real-world protection plan. Rule number 4, build your crash buffer and rebalance like an adult. This is the most unsexy rule, which is exactly why it works. When markets are rising, everyone talks about returns. In real retirement life, what matters is what you do when markets fall. Because a crash doesn't just test your portfolio, it tests your identity, it tests your marriage, it tests your sleep, it tests whether you keep contributing or stop. And here's the brutal irony. The worst financial decisions most people ever make happen inside their own fear. Graham's defensive investor doesn't pretend fear doesn't exist. He designs around it. That's why asset allocation matters. That's why bonds and cash are not dead money. They are optionality. They are dry powder. They are psychological stability. They are what keep you from doing something fatal. If you're 25, your bond allocation might be small. If you're 55, it might be larger. The exact percentages depend on your situation, time horizon, risk capacity, and how you actually behave under stress. But the principle is universal. If your portfolio is built so aggressively that you cannot emotionally tolerate a major drawdown, then your portfolio is not optimized. It's booby-trapped. And here's the part that connects directly to big losses. Big losses happen when investors are forced sellers. They lose their job, or panic, or need liquidity, or can't handle the headlines, and they sell low. You don't need to predict crashes to avoid that. You need a buffer. A buffer can be a reasonable bond allocation in your 401k, a cash emergency fund outside the market, and a plan to rebalance instead of react. Rebalancing is the behavior that most people avoid because it feels like doing the opposite of what feels safe. When stocks run up, rebalancing trims a little of the winner. When stocks crash, rebalancing forces you to buy what feels terrifying. This is not about being contrarian to be edgy. It's about buying low and selling high without needing courage in the moment, because the decision is made in advance. Rebalancing is how you turn Mr. Market's mood swings into your advantage. And now we can close the loop on why Rule 4 is so powerful. If you have a crash buffer and a rebalancing policy, a crash is no longer a moment where you ask, should I sell everything? A crash becomes a moment where you ask, am I still aligned with my allocation? That's a completely different mental frame. It changes the outcome. Now, let's put these 4 rules into a one-page blueprint, something you can actually use, not just nod at. Here's the Defensive Investor Retirement Blueprint. First, put your retirement on a core satellite structure. Core, broad, diversified, low-cost index exposure, S&P 500 or total market, and an appropriate bond allocation for your age and temperament. Satellite, if you must, a small limited sandbox for speculation, a number you could watch go to zero without changing your life. If you can't set a limit, you don't get a sandbox. Second, enforce financial strength. If you pick stocks, You screen for balance sheet safety, manageable debt, good liquidity, consistent earnings power. If you don't pick stocks, you avoid concentration in fragile themes, and you avoid overloading on employer stock. You diversify like your future depends on it, because it does. Third, demand a margin of safety. For stock pickers, no paying for perfection. No buying because the story is popular. No, it can't lose logic. For index investors, no chasing whatever just outperformed. No rotating based on fear or hype. Dollar cost average through noise. Fourth, maintain your crash buffer and rebalance. Have an emergency fund so you're not forced to sell in a downturn. Set an allocation you can live with and rebalance schedule, quarterly, semi-annually, annually, something consistent. And let's add a silent fifth element that Graham would absolutely approve of, because it's one of the most common permanent losses in retirement investing. Watch your fees, expense ratios, hidden fund costs, advisory fees. These don't feel dramatic like a market crash, but they quietly compound against you for decades. A 1% fee doesn't sound like much. Over 30 years, it can be the difference between I can retire and I have to work longer. Fees are permanent loss in slow motion. Now let's bring this back to the emotional reality. You're building a 401k. You're doing what you're supposed to do, and the world is loud. Inflation headlines, interest rate debates, election seasons, recession talk, AI mania, market crash predictions, social media, making it feel like everyone else is getting rich faster than you. This is exactly the environment that turns ordinary people into accidental speculators. Not because they're foolish, because they're human. And Graham's genius wasn't that he found a magic formula. It's that he built a philosophy that protects humans from their own most expensive impulses. He taught you how to stop outsourcing your future to Mr. Market's mood. So if you're watching this and you feel that quiet fear, what if I make one bad move and ruin my retirement? Hold on to this. You don't need perfect timing. You don't need perfect picks. You don't need to be early. You need rules that keep you from making irreversible mistakes. Draw the line between investment and speculation. Refuse fragility. Demand a margin of safety. Build your crash buffer and rebalance, and then do the hardest thing in modern finance. Be boring on purpose, because boring, done consistently, is how middle-class people actually win. In Graham's world, the first job of an investor isn't to be brilliant, it's to be unbreakable. And if you want, take these 4 rules, write them down, and the next time Mr. Market shows up at your door, euphoric or depressed, you'll already know what to do. Not because you can predict him, but because you no longer need to.